Hello students. In our previous video we discussed the ledger concept and the problems. So in this video we are going to discuss bank reconciliation statement or BRS, which is one of the most fundamental skills every accountant must master and every accounting student needs to understand thoroughly. In professional accounting, BRS is your daily reality. Please remember. You will have to prepare monthly reconciliations to ensure company books matches with bank records exactly. So this process helps to detect errors, unauthorized transactions and potential frauds. Employers expect you to identify discrepancies quickly and resolve them efficiently. Without strong BRS skills, you risk missing critical financial irregularities that could cost your employer or company in thousands. It is also essential for audit preparation, tax compliances, and maintaining accurate cash flows that management relies for decision making. It is also essential to master this BRS from the perspective of analytical thinking and attention to detail. It teaches you how real world accounting works beyond the textbook theory. BRS questions frequently the student's ability from the exam point of view as well as from the life point of view, professional life point of view. So many professional qualifications like CA, CMA, CS, all these courses will have this particular bank reconciliation statement concept. So students, we have to understand in this the timing difference, the outstanding checks and deposits in transit, and understanding these will strengthen your foundation for advanced topics like cash management and internal controls. So let us dive into this the concept of bank reconciliation statement. Bank passbook, it is a copy of customer's account in the books of bank. Bank sends it periodically to its customers in which all the deposits and withdrawals made by the customer during the particular period is recorded. It is basically a formal communication made by the bank to its customers about the transactions made by the customer or bank transactions based on the standing instructions given by the customers. You might have gone seeing the passbook of your parents, or in fact you might also having the bank account. So you definitely you might have gone through the passbook statement. So the passbook format is like date, transaction reference, document reference, withdrawals, deposits, and closing balance. If you carefully observe, the debit and credit are the crucial part in the passbook. It is basically when you deposit money into the bank, the credit balance in the passbook increases. When you withdraw money from the bank account, it will be debited in the passbook statement. So it is important to note that bank account as per books and bank statement are different in nature as to its balance shown in passbook and the cash book. So debit balance in the passbook represents credit balance in the books of records, whereas credit balance in the passbook represents the debit balance in the books of accounts. It is opposite in nature. Please remember this. This is basically due to the rights and obligations of the customer and the bank. When customer deposits into the bank, bank owes money to the customer, isn't it? Which is a liability to the bank. So for us it is an asset, for the bank it is a liability. So that is why the passbook shows credit balance and in our books of record it shows debit balance. So when the money is deposited into bank, the bank owes us. So bank for them it is a liability and for us it is an asset. And you should also remember that accountants passes entries based on the occurrence of the transaction. However, in certain transactions, the accountants record the transactions made through bank basically only upon receipt of periodical statement, isn't it? So, upon the intimation of the bank, accountant will pass entries. Hence, most of the times, the passbook and bank account as per books do not match. So, the reasons could be timing difference and difference due to errors. So, the differences which we are going to discuss in a subsequent stage, you will understand why there will be a difference. Imagine you and your friend are both tracking of money in a shared account. At the end of the month, your record shows 10,000 and while your friend's record shows 8,500. Who is right here? So this is exactly what happens in business between your cash book and the bank statement. Reconciliation is the process of comparing these two records and explaining why they show different amounts. Think of reconciliation as being a detective. You are not looking for who made a mistake, but understanding why two correct records can show different numbers at the same time. Reconciliation is the process of matching and explaining the differences between two related financial records. In banking, it's comparing your cash book balance with your bank statement. The goal isn't to make both records identical immediately, but to understand and document why they differ. Once we understand the reasons, we can determine the correct financial position, isn't it? So, a bank reconciliation statement is the document that lists all the differences and shows how one balance can be adjusted to match the other. It's like creating a translation between two different languages of the same financial story. The reasons why cash book, see students, you should understand the moment I mention cash book here, it is actually the bank account as per the books of accounts. So for understanding sake, the entire BRS we mentioned cash book. So cash book here refers to the bank account as per the books of accounts. So the main reasons why cash book and bank statement balances differ is due to timing difference and the difference due to errors. So let us understand what is timing difference. So timing difference is the most common reason you and the bank record the same transaction at different times. For example, you write a check today and record it immediately, but the recipient deposits it 3 days later, isn't it? So another example, you deposit a check and add it to your records, but the bank takes 2 days to clear it. In our subsequent sessions, we will be discussing why the difference arises in the check transactions. And another major reason why there is a difference in cash book and the bank statement is due to errors. You might record 1,000 rupees instead of 10,000 in your cash book, or bank might process a transaction incorrectly, or you might forget to record a transaction entirely. So there could be timing difference, or it could be difference due to errors. Now remember, reconciliation doesn't mean both records are wrong. It means understanding why two correct processes can show different results at the same point in time. Most differences are timing related, and we will resolve themselves. It will resolve themselves as the transaction gets processed. The bank reconciliation statement simply explains these differences early. So now let us understand how this bank processes checks and which results in timing difference. So when you write a check to pay your supplier and immediately you record it in the cash book, so reducing your balance by 5,000 rupees. But when you check your bank statement the next day, it is still showing the balance. That 5,000 is not reduced. It is still there. Is it a bank's mistake? No, not at all. This is completely normal. Let's understand how banks actually process checks and why timing difference occurs. When you write a check, it goes on a journey before your bank account is actually debited. Here is what happens when in the day one when you issue the check, you write the check and give it to your supplier. You immediately record this in your cash book as a payment, isn't it? As per accrual concept. So your cash book balance reduces by 5,000 rupees. In day 2 or day 3, if the recipient deposits the check, the supplier deposits the check. So this, due to various reasons, they could be busy or there could be a bank holidays. So if they have deposited in day 2 or day 3, your supplier takes the check to their bank and bank will not immediately do this. They could be timing difference from the banking activities as well. So there is a clearing process as well in the banking activities. So in day 4, the clearing process begins. The clearing means the supplier's bank sends your check to the clearing house, which forwards it to your bank for verification and payment. On day 5, your bank processes the check. Your bank verifies whether there is a sufficient balance and finally debits the 5,000 rupees from your account and your supplier's account will be credited. So only now it appears in your bank statement. So the entire process of this, when you issue check, so the entire process takes 2 to 5 days, sometimes longer if there are holidays and or weekends involved. So this processing delay creates the timing difference. So I hope you have understood the timing difference arises due to